Good afternoon to everyone on the East Coast and Central Coast, and good morning to everyone joining us today from the West Coast. My name is Nicholas Goods, co-founder of Succession Link. Thank you all for joining us today to listen to Mike Strakhov, Executive Director, Insurance Agency Lending for Live Oak Bank. Today's webinar, Financing Your Agency Acquisition in a Competitive Market, will cover important topics in the agency acquisition space. Before we begin, I'd like to cover a few housekeeping topics regarding the Succession Link platform and updates that you might not be aware of. For those of you not familiar with Succession Link, the platform was introduced in 2013 to address the succession and continuity needs of financial advisors. We saw a tremendous amount of success and had requests to provide a similar solution to the insurance and CPA space. As of the first quarter 2017, the insurance segment of Succession Link was officially rolled into the main platform. We expect to have a similar solution for CPAs near term. As you can see, the numbers indicate a strong need for succession and perpetuation planning across advisory, insurance, and CPA segments of the financial services space. At Succession Link, our goal is to provide the tools and resources necessary for financial professionals such as yourselves to engage in a meaningful dialogue with local users, whether it be to buy, sell, merge, or find perpetuation or continuity for your agency or practice. We provide a number of additional features in the platform, which I'd be happy to discuss with you at a later time, and I'll be providing our support contact information for anyone with Succession Link platform questions after the call. Now I'd like to hand it over to Mike Strakhov at Live Oak Bank to begin the presentation. Mike?
Thank you very much, Nick. I'd like to thank you, as well as Succession Link, for the opportunity to address you all today. Welcome to Financing Your Agency Acquisition in a Competitive Marketplace. As Nick mentioned, my name is Mike Strakhov. I'm Executive Director of Insurance Lending at Live Oak Bank. Quick background, I have 27 years in the insurance business as a background prior to joining Live Oak Bank. I've had agency experience as well as carrier experience. I've seen the industry from a bunch of different angles, including a claim adjuster, selling commercial insurance, managing a number of territories for national insurance carriers, as well as acquiring agencies as a member of an acquisition team while on the agency side. So I say all this to tell you I'm more of an insurance person than I am a banker. As I spend more time with bankers, it's probably heading in that direction. But it gives me a relatively unique perspective of the industry and really a perspective, maybe your perspective in your shoes as you look at potential acquisitions moving forward. Anyone who has bought or sold or even looked into buying or selling an agency, or even read in insurance periodicals and journals, easy to see that there is a lot of transaction activity. Agency consolidation is on the minds of not only agency owners, but also insurance carriers as they look at the landscape down the road and what all of this activity means for them as they try and distribute their product in the most efficient way. There certainly seems to be more buyers and sellers out there, and there are a number of trends out there that would indicate that this level of activity will continue for some time. So with that, we'll jump into the presentation. The agenda for today, we're going to talk a little bit about the current landscape, also some trends in agency consolidation, steps to winning a deal, and we'll go through some best practices that will help steal deals and some potential pitfalls in things that may kill a deal. This first slide, as you look left from right, is really a view from the Independent Agents and Brokers of America and their study that occurs every 2 years. They kind of look and see how many agencies are there out there in the universe of independent agencies. And you'll see in 1996, at least through this time frame, really was the high of about 44,000 independent agents in the country. You'll see a slow decline in around 2006. The number gets to about 37.5, stays relatively stable, ticks up a bit, and then you see the number at 38,000 through 2016. So basically, it's really kind of leveled off to some degree. There is definitely some changes year to year, but for the most part, anywhere between 37,500 and 38,000 agencies is really the estimated number of independent agencies in the country. So let's take a look at the M&A transactions. So what has been the activity from 2011 to 2016? This slide comes from Optus Partners, and what it represents, you'll see the numbers, again, working left from right, 2011, 289 transactions, and 2016, 449. So what do those numbers mean? There are a number of entities that report transactions on an annual basis. So this is what's considered reported transactions. So if you're a public entity, a private equity firm, a national broker, or any other agency acquirer that you want to make your information public, you do so, and then there's a number of organizations to keep an eye on that and track those transactions. So you'll see in 2014, the number 359 jumps up to 456, which was a record high of transactions since they've been keeping record of these. And then you'll see a slight decline in 2016 at 449. So again, using the thought of reported, there's a whole other population out there that we're going to call non-reported transactions. These are the ones that don't make the paper. There's no official organization that tracks these numbers, and they are not, you cannot go to one central location and figure out, how many overall agency broker transactions were there in any given year. But the estimates are that this reported number, so 2016, for example, 449 transactions is a small percentage of the overall transactions, that those that go unreported are substantially higher, maybe a multiple of 8 to 10 times more than that 449. So most of these are, a private firm, local retail agency buying the agency either across town or across the street. They do a deal. It could be potentially be seller financed. They may seek financing, but in any event, they consummate the deal, and that goes relatively unnoticed, particularly on a national scale. And there's nobody out there really taking a look at that. So really the point is transactions are certainly increasing, particularly in the reported space. But this also holds true for the unreported, we'll call them maybe smaller transactions, that there is no centralized reporting mechanism for those. So who is buying these days? And again, this relates to those reported transactions, so data on the information that we just talked about. The largest, and continues to be, and you'll see that their percentage of the number of transactions they do is private equity. So you'll see and hear and read about private equity firms that are either backing brokers or actually developing funds on their own to acquire agencies. And I would say most of their target agency is the larger revenue, let's say north of 10 million for a general number in revenue. Could be lower, likely higher, but they are seeking, certainly as much revenue as possible, typically in a deal, and they are putting resources to it to buy larger agencies typically. So they represented in 2016 about 53% of all transactions, about 237 of that 459 number of overall transactions I mentioned earlier. Behind them are private firms. So those are obviously non-public, non-PE. And then public brokers, 9%, approximately 41 transactions in 2016. Banks are still active, but not nearly as active as they once were. Looking back even into 2011, 2010, representing a great or a larger percentage of the overall transactions than you did see in 2016. So they've slowed, but still active. And then you have an all-encompassing 5% of other. So it's non-private equity, not a private agency buying another agency, not a public broker or a bank. So there are other buyers out there. Not sure exactly who's included in that other 5%. So what's the seller type? So we talked about overall transactions, who's buying. Let's talk about who's selling. So this graph depicts that over 50% of the agencies that are for sale or have sold in 2016, over 50% of them were purely property casualty agencies. The next largest group is employee benefit agencies, and they would be either exclusively employee benefits or exclusively property casualty. And then the third largest group is a combination, those that have employee benefits and property casualty. That represents about 18% of the transactions in 2016. So property casualty by far seems to be the most popular type of agency to sell at this stage of the game. So what's this mean? What could this look like for the foreseeable future? And again, a big I number. So the Independent Agents and Brokers of America, this is part of their 2016 Agency Universe study. And a lot of the dialogue and writings up until 2016, it talked about the aging demographic of the agency principal. And while that's still something to think about, and I wouldn't say a concern, but something to watch closely, is that they found in 2016 that the aging of the insurance agency universe may be slowing. And really, if you dig behind the numbers, the last time they did the report in 2014, the average age of an agency principal was 56. And in 2016, it's 55. So a slight decrease, let's say, of 1 year on average. But again, maybe an encouraging trend. It is showing, signs of it getting quote unquote younger. The second major finding was 40% of the agencies that were surveyed indicate that they are going to have a major ownership change within the next 5 years. So taking a look at some of these numbers and trying to get a sense for what that might look like, there are a significant number of agency owners right now that are contemplating what their next step is going to be. And obviously, at some point, every agency principal needs to make a decision. What's their plan? Do they plan on continuing for a period of time? And if so, for how long? In the event or when they're ready to make that transition, what's that going to look like? Are they going to sell to an external party? Or are they going to perpetuate internally? But at some point in time, there's going to be a need for them to make a decision on what they plan on doing. And this will further feed the number of agency transactions, in our opinion, moving forward. So a lot going on in the insurance agency space as it relates to transactions currently, and we anticipate this to continue for the foreseeable future. Now let's talk about the steps to winning a deal. As you can see from this slide, there are a number of things that we're going to talk about in preparation for acquiring an agency, the approach, taking some time to figure out what that's going to look like. We'll spend some time on the value and price as you get into the process. What are the things that you should be looking at and considering as you are working through the deal? How are you going to finance the deal, and what's that structure look like? And what's the likelihood of finding a deal that works both well for the seller and buyer? And then transition. This is something that obviously through this process, you can't get into the transition until the deal is closed. But in many respects, it could be one of the more important aspects of winning the deal, because part of winning the deal is making sure that the deal works post-closing. And there's a lot of things that you need to be thinking about in transition through the deal that will ensure that post-transactions things go well. The first step is preparation. And what we suggest is take a look in the mirror. And really what you want to do is make sure before you go through the process, start considering or even making offers or having conversations, that you really feel that your house is in order, that you're not in a situation where there are things that need to be addressed on your end that could be compounded or exaggerated once you either start going through the process and certainly after you conclude an acquisition, that if there are issues beforehand, they could be magnified post-transaction. So looking at it from a number of different angles, the first being staffing. Are you currently staffed, and do you have the right staff that can currently handle the demands of your agency? And is there capacity for those folks to potentially help out through the acquisition process? Any issues with customer service, office operations, new business acquisition, really making sure that you're clicking on all cylinders on your end is important, because again, you want to make sure that that continues and is not completely disrupted as you start thinking about and going through an acquisition. And ultimately it comes down to, is this the right time? And again, it's rare in most instances that everything is perfect and neatly in rows and neatly in boxes when you start thinking about whatever the next great adventure is for your business. But to the degree that you could have as many things in order as possible, that will be less of a distraction and less of a risk as you move through the acquisition is going to be important. Do you have the capacity? So this is something that better to face now and realize that an acquisition is going to take an awful lot of your time, and potentially the time of your teammates to help you get through this acquisition. So take a realistic look at your agency and your personal capacity to get this done. And there's no shame in realizing that the answer to that question may be no, and there may be opportunities to get outside help. And in cases that you don't realistically have that capacity or your staff does not, it really makes sense. Will make your life easier in the long run. Make sure that you do a better job through due diligence, but making sure you do that analysis beforehand is important. And then obviously, what is the financial situation or condition of the agency at this stage, prior to acquisition? Is your business bankable? It's not the time to find out that, your agency has some cash flow challenges when you're sitting in front of either a banker or a seller trying to work out a deal and figuring out if you can make this work. Really kind of do the analysis now to say, hey, how financially strong am I, and how would a financial institution view my agency in the event that I need financing now before you're at the heat of the deal, want to get it done, and find out there's a number of challenges and obstacles. A lot of that is driven by your history. So do you have a history of profitable growth? And that's certainly important for a lot of reasons, but certainly an indication of a well-run agency. What is your cash flow? And we're going to talk a little bit about what that means. But making sure that you have a reasonable, if not exceptional, cash flow for your agency that will help support debt, shows evidence of quality management, and the ability really to manage the aspects of your agency that are important to ensure that you have the appropriate cash flow to complete an acquisition. And then personal credit worthiness. Part of a financing or seeking financing is going to be a look at your personal finances. So understanding what those are beforehand, what's your FICO score, do you have any derogatories on your credit report, have you been timely in paying your bills? All of these things are important to know. There's likely things that you can do now to clean things up prior to either applying for financing or moving forward with an acquisition. Make sure that you're in the best possible position from a personal credit perspective. Know your target. Understand what you're looking to buy. So a lot of agents, if you sit in a room and ask them who's interested in acquiring an agency, half, if not more, of the room's hands will go up. But when you really get into it, what exactly are you looking for? So you want an agency that's in town, in the county, in the state, your side of the state. Would you be willing to go outside? Things like that are good to know based on your analysis internally and what you're able to manage. The size of the agency. Are you looking for an agency of similar size, something bigger, something smaller? What do you think that you'd be able to handle from an acquisition perspective? Are there specific lines of business that you're interested in? Are you an expert in workers' compensation for a particular industry, and you're looking to complement that capability with other lines of business or other industries? What is it that you're looking to do? Is it commercial lines acquisition? Is it a personal lines acquisition? There are a number of things that you should think about as opposed to evaluating deals as you see them, trying to figure out whether you can do them or not. Really laser focused on what type of agency are you looking for. Strategic alignment. Are there things that you're looking to grow with a specific carrier to a certain spot that allows you to take advantage of additional incentive compensation, let's say, or an industry that is a good complement to the current industry that you may focus on right now, or the product mix? Are you a commercial construction agency, and you think you could acquire a surety agency that would help complement current capabilities in a way that you can cross-sell your book and provide additional services to your clients? So there's a number of things that you certainly could look at to expand the product offering and or expertise of your agency through acquisition. And then agency culture. It's not last on the least because it's least important. It's probably words I'd like to leave with you, particularly on this slide, is that the culture of the agency, as you look at an acquisition, is going to be extremely important for a lot of reasons, and particularly through the transition and getting everyone on board and, kind of what the customers expect based on the target agency's culture. It's going to be important for you to know and analyze and really give some thought to how well is that going to integrate into your existing culture. So taking a look at that and understanding it and really giving it some thought on, is this a cultural fit for your agency, can be a big determination of how successful the transition goes. Why should the seller pick you? So we talked about the competitive landscape. We talked about the number of acquisitions that are occurring. It really comes down to when you are making an offer to acquire an agency, one, it's likely that there's other buyers, so you're likely in a competitive situation. Might not be the case, but most times there is. So really there is a sales piece, obviously, to this. And on the slide, there are a number of things for an agency considering acquire to kind of put down in their kind of toolbox of the benefits that they think they bring in an acquisition. What are they currently doing really well that might be of interest to the seller? But ultimately, you really need to have a conversation with the seller, get an understanding of what they're looking to accomplish through this acquisition, and really take maybe this list or an extended list or the one that you create and really put together your sales pitch on why you are the best possible pick for the seller. And there are a number of reasons other than cash and price that could come into play. And some of those might be, the seller is interested in continuing working. So what's that look like? And can you facilitate that through the acquisition process? Some sellers are incredibly concerned about the acquirer making sure that their employees are taken care of and that they all have jobs post-acquisition. Some are certainly looking to maximize cash at close, or structure could be a big part of what they're really most focused on. Some may own a building, want you to continue to be a tenant in that building, or want you to buy the building. So there's likely some pretty unique aspects of the seller's interest that you're going to need to meet. And the more you understand that, the better proposition I'm sure you could put forward. But there's a number of things within your agency that would be important for the seller to know, and how that might be beneficial to their customers, to their employees, to the great name they've created over time. This is typically an emotional sell, and a lot of times you need to appeal to the emotional side of that sale. But making sure that you're giving it some thought on how you're going to sell this agency to the seller is important. And that last bullet point, selling as in, you really got to do a real good sell job to the seller to make sure that they're comfortable with you as the next owner of their basically life's work. Next, I'd like to talk a little bit about value and price. We get a lot of questions with regard to, is this a good deal? Am I paying too much? Is it a value that the seller has put on this business? Is it reasonable? Is it something that, makes sense? So we have a couple ways of looking at that. And many times we have agencies that come to us and say, hey, I'm thinking about buying this agency, or we've had some discussions and we've agreed to pay a multiple of revenue. So 2 times revenue, let's say, or 2.5 times revenue, 1.5 times revenue, which I think for conversation pieces, probably a good starting point. But ultimately what you're buying in this acquisition is the free cash flow of the agency, and really going through a process that determines what's the EBITDA, so the earnings before interest, taxes, depreciation, and amortization, is really a very solid financial analysis of really what you're looking at from an acquisition perspective. So really what that is, it's the cash earnings of the agency. This is the income stream after expenses that you'll be buying. So if this is really what you're buying, to do an analysis of what that actually looks like is much more sound than just taking a sheer multiple of revenue, because there may be situations where there really is no positive cash flow for this agency. And you want to make sure that you understand what's going on in the agency, how much free cash flow is it spitting off, and this will allow you to do that. Basically, you take your cash earnings, you eliminate eliminate interest and taxes, all the non-cash expenses, depreciation, amortization, and then we go through a process taking a look at what we would consider to be add backs. So if the owner is not staying on, the seller's compensation would be removed. If there are expenses in there that will not continue post-acquisition, really make some adjustments to the balance sheet to get a sense of really what's the EBITDA look like on a pro forma basis, excluding what the seller may be taking as compensation and or may have had expenses in there that might be duplicates and no longer necessary or could be eliminated just on their face. To give you a sense of what we typically see, agencies under $2.5 million in revenue tend to be valued somewhere between 5 times to 7 times EBITDA. There are exceptions, and depending on that particular agency, there might be aspects of it that are more attractive or less attractive to the typical buyer. You have some buyers that are just hot and heavy, love the agency for a lot of different reasons, that are willing to pay more than that. But generally speaking, 5 times to 7 times EBITDA is a good rule of thumb. Multiple of revenue, again, not a bad kind of beginning point, a yardstick, but you really want to make sure that you do your homework with regard to what is the free cash flow of the agency, and then determine that as a multiple. Financing and structure. This is a typical deal that we would see for an agency acquisition. So a selling agent is looking to exit the business. They obviously identify a buyer. The buyer comes to us. We provide financing anywhere from 25 to 75% of the financing, leaving 25% for either a down payment or a seller note. So it's typically a combination of both. So what that would look like, so it's $1 million purchase price in this example. $750,000 of that comes from a live oak bank note. It's a 10-year note, prime plus 2.25 would be a good example of a rate that we would put out there. No prepayment penalty on that note as well, so it gives a lot of flexibility over a 10-year fully amortizing loan. Debt service on that is approximately a little over $100,000. The seller would hold a note, so in essence, they are providing financing by holding some of the note of about $200,000. That could be, example here, 5 years on a 6% interest. Debt service on that is approximately $58,000, and then the buyer would put down a down payment. In this example, it's $50,000. There's no set requirement of what that down payment will look like. We like to work with our borrowers to understand, what can they afford, what's their liquidity situation. But in this case, there was a down payment of $50,000 on a $1 million transaction price. So that's typically what you would see from a structure: a live oak financing piece, a seller note, as well as a down payment from the buyer. Again, on the financing structure, a couple variations. You might see somebody that will have a base purchase price and then a guaranteed payment post-close. So that could be, at close, we're going to pay you $750,000. 2 years out, there's going to be a second payment in the amount of $250,000. So there's a guaranteed upfront money and a guaranteed payout at a future date. Many deals will have an earnout piece. There are agreed upon metrics that if the agent meets, they would be entitled to a post-close payment in addition to what they received at closing. Example might be $750,000 at closing, and then you have a earnout based on $250,000 as the potential additional payment post-close if the agent meets certain things, either from a profitability perspective, growth perspective, retention, etc. But there are conditions put around that. Many times we see that the seller likes to stay on or wants to stay on for a period of time, let's say 12 months, or there are key employees that need to be part of the deal moving forward. Many times that's included in the purchase agreement. And then office buildings. We do see a number of agencies that own buildings, so they may want you as the acquirer to either buy that building or at least agree to a portion of time in which you would be a tenant in that building, 2, 3, 5 years, that you're going to agree to stay in that building. And again, that can be part of the deal and something very important to the seller. So you need to be aware of that as potential. So just a few, quick list of things to consider in the financing is obviously the term of the loan. Is the term 5 years? Is the term 10 years? Biggest impact there is, the impact to cash flow. In 5 years, your monthly and annual debt requirements are going to be higher than it would be in a 10-year, because obviously, you're stretching those payments out over a longer period of time. Servicing fees, keep an eye out for the potential for there to be ongoing fees beyond, closing costs. So some banks may require, or lending institutions may require, a 1 or 2% servicing fee on that loan for the duration of the loan. Obviously, rates, interest rates. What's the rate applicable to you? That goes without too much explanation. Amortization is really probably the best example, or what I mean by that being on the list is you could have a 5-year term loan with a 10-year amortization, meaning through the first 5 years you're paying that loan like it's a 10-year term loan, but really it's a 5-year term loan. So at year 5, there's going to be a large balloon payment that's going to need to be paid, which is basically the balance of the loan. So sometimes you could have a 5-year term with a 10-year amortization. Ultimately, the longer the term and the amortization gives you greater cash flow flexibility. Redirection of commissions. Some lenders will set up an account, require that you have commissions go into that account, and the lending institution will take out their monthly payment first and forward on the balance to you. If that is something that you don't like, that is certainly something you need to be aware of on the upfront and make sure you understand how it works if you're going to agree to it. Excuse me. In any lending situation, collateral is important. So understanding what the collateral requirements, if any, are going to be part of the loan process, and understanding what that looks like upfront is, again, very important. There are some penalties associated with a number of loans that could be particularly for prepayment. So if you have a 10-year, 12-year note, and there's a 1%, 2%, 3% prepayment penalty associated with getting out of that early, it really kind of locks you in, particularly earlier on. In the event you want to pay that off, there's going to be expenses associated with that. Balloon payments, we talked about. That really is a situation where there's a term and amortization do not meet or are not equal, and there's likely going to be a balloon payment. Industry expertise. Having a lender that understands the business is important because the insurance industry, particularly agents, very unique for a lot of reasons, really unique vernacular, agency bill, direct bill, contingent commission, incentive comp, all of these things really take some understanding, probably terms we all take for granted in the industry, but certainly specific to insurance and something that the industry expertise can help the loan process, and really having a conversation with who knows what they're talking about can help the loan process along. Closing costs are always part of it, understanding what those look like. Some and most loans have covenants, meaning in the event that you violate a covenant, it could be a financial ratio, that the bank has the ability to default on your loan, call the note. So you want to understand what those covenants are and what those situations are, and make sure that they're reasonable, and you can work through those if in fact they do exist. And then speed. What's the loan process look like? We talked to a number of agencies that have these kind of opportunistic situations that pop up, that yes, they were always interested in acquiring an agency, but this one so happens to be the friendly competitor across the way. They need to get out for whatever reason. They're looking to sell the agency to you, and now there is some type of tight time frame surrounded by that. So understanding what is the lending institution's loan process, typical closing times, and what they need from you, and being able to provide that to the lending institution is going to be important to make sure that they can meet your timelines. So transitions. So you've gone through all the gyrations, discussions, negotiations, talked about everything, really kind of nailed down everything, got to the close. Everything was paid, got your financing, seller's happy, you're happy. You've had the parade, you popped the champagne, and now it's time for the real work. So really what you want to make sure from a transition perspective is that you have the ability to successfully, onboard, if you will, the agency that you just acquired, and make sure that that goes in the most efficient way possible. So talking about transition post-acquisition is probably a little too late. Really, you want to have a transition plan that you're discussing with the seller, with your employees, with the employees of the seller to the extent that you can, to involve them in a process of making sure that you can transition this agency in a way that is not disruptive to employees and not disruptive to clients, because you really want to make sure that the revenue that you acquired, that free cash flow, is something that does exist post-acquisition and you've done everything possible to preserve that through this whole transition. So how to do that? Work out a plan for how you're going to contact the clients. What's that look like? Are there any concerns? And what's the seller's role in doing that? What is the seller's role in announcing the sale to their employees? What's your role in that? How are you going to make sure that that goes smooth, make people feel comfortable? Is there a one-on-one time? Are you going to schedule a group meeting? What's that look like in understanding overall, how are you going to communicate both internally and externally? As well as sellers' involvement in most things. Are they a cash buyer 100% at close and completely out of the picture? Or do they want to continue to at least help in the transition, if not work beyond that in some role within the agency? And understanding what that expectation is through the process and before close is going to be important to know that there's no mystery post-close on what that role of that person is going to look like. And the plan should be written and agreed upon. So a lot of conversations take place through this to the degree that you can formalize and make sure that everyone's on the same page. It really reduces the possibility for there to be any confusion and/or dispute post-acquisition. Again, in the transition, potential deal killers, not engaging the emotional side, clients, employees in the transition. There is time where, or there will come a time where your clients, your employees are going to need to know exactly what's happening. And many times the seller will have a better pulse on what that might look like for that group. Finding out if there's anyone that's going to be, quote unquote, either disgruntled or concerned with this, knowing who those are and making sure that you're taking the time to understand how you're going to have those conversations and what that looks like is going to be important, and really understanding the client reaction. And a lot of times, the seller's post-acquisition is going to be important for them to understand. Not getting experts involved when appropriate, that certainly can create some huge problems. If there are legal documents and some other things that people are trying to either do it on their own or get it off the internet, or you're seeing all sorts of valiant attempts, but unsuccessful attempts to get the information over to us, you may need to get experts involved. And then differing opinions on the value. The sooner you come to a full agreement on what the value is and the structure of the deal, the better. If that is an ongoing discussion that continues to be negotiated, that typically doesn't end well. Best practices: comprehensive plan and milestones with who's responsible for what, getting evaluation done early in the process to help you get to that kind of full agreement on the price. Manage your emotions. This can be an emotional process, and understanding that there's emotions on both sides of the equation, making sure that you can work through those in a productive way is important. And then hire professional support if necessary. 5 things that nail a deal: valuation, understanding of purchase price. You've talked about that a couple times already, but that's critically important. The financials are strong on both sides of the deal. A lot of folks look at the quality of the target, but don't necessarily take the time to make sure that the quality on their own, their agency, is very strong financially, which could be critical as a financial institution does the analysis on whether they're willing to provide funds for the deal. They're really going to look at both agencies, the one you're running and the one you're targeting. So you want to make sure that they're strong on both sides. Cultures are a good match. And again, don't shy away from the emotional side. This can be really, really important for a successful transition of an agency. Create a roadmap for the new agency to the degree you can, sooner the better. Involve staff of both firms and involve the clients whenever possible. So depending on how you both agree that the notification to clients will take place, really understanding what the best possible way to go about that, and really working to that end to make sure that clients are comfortable with this transaction and what it means for them is going to be important. And then having a clear seller transition plan. So I'd like to conclude with a couple comments on Live Oak Bank. The bank was founded in 2007 and is a specialty lender. We lend nationally, so we lend in all 50 states, and we are an FDIC insured bank. Today, we're over 400 employees. Actually, I heard the other day, we're actually now over 500 employees, and we lend to 14 specific industries. So we are a specialty lender. We stick to the knitting on those 14, And independent insurance agents are one of those industries that we've dedicated time and resources to serve. We remain at having one of the lowest default rates in the country of less than 1%, which we're very proud of. And we are the second largest SBA originator in the U.S. So while we do a large volume of loans, we are celebrated for one of the lowest default rates in the country. And a lot of it has to do with our focus on specialty lending and having people from each of the industries in which we serve have somebody involved in that team that comes from industry that can help select and create the strategy to pursue that specific industry. So the Live Oak insurance team, 5 people, all we handle is insurance loans. So if you were to speak to anyone on this group, we are all dedicated to insurance agency financing. And so it's an elite group. We take pride in that. So we're very siloed from that perspective. And we want to make sure that the person on the other end of the phone is somebody that's familiar with the industry and understands your business. So that is the list there. We like to meet every borrower that we can. Typically loans over $350,000. We will come to that agency, shake a hand, get to understand that person, their goals, what they're trying to accomplish. But we do think it is important to have a relationship at that level. So with that, that concludes my comments relating to the webinar today. I hope you enjoyed it. Welcome to the Financing Your Insurance Agency Acquisition in a Competitive Market. We'd like to open it up for questions. Nick, do you have any comments before we do so?
Yeah, thanks, Mike. That was a great presentation. I know it's a lot of information to absorb over a short period of time, and I know we've gone over our 30 minutes, but would like to open it up to any questions that our audience has at this time. And, we're certainly here to follow up as well. And I can distribute that presentation to any users who are interested in learning the landscape around the investment advisory side.
Yeah, the only thing I would add to that, Nick, is that Live Oak Bank is pretty siloed. So Mike McGinley certainly would be when he spoke, certainly providing the expertise around that. I focus exclusively in the insurance space, so I wouldn't be able to comment on that. So it might be useful to direct people to that presentation.
Perfect. Another question, agency valuation contacts. I know we have a couple of valuation contacts on the investment advisory side, and we recently pulled in the insurance segment into Succession Link, so we will have some shortly. Mike, does Live Oak Bank have any agency valuation contacts?
We do. We have a number of them, both some that do national type work, some are geographic, but certainly can provide information if someone wants to reach out on some of the folks that we see out there that we think do a good job. There are a number of options.
Okay, great. Another question came in. Do you look at internal acquisitions differently than external?
We don't. I mean, our evaluation when it comes down to financing truly is a cash flow analysis. So really from a purchase price, really we're just going to go through the similar gyrations on the overall price and how well does it finance. The positives of an internal versus an external, there are many appealing aspects of an internal perpetuation, including, the candidate or the person, the buyer, is from that agency, is familiar with the book of business, the agency, the employees, the clients. We see that as a positive. There's less transition risk in those situations. But for the most part, we're going to look at every deal from a cash flow perspective. So that, in essence, treats every deal very similarly, let's say.
Great. Another question came in. How long of a process does the loan deal usually take once you receive the necessary financials?
So I'd break that into 2 different component parts. So initially what we ask for is just enough information to provide the potential borrower with a proposal letter. So that's really tax return information. There's probably about 10 items that we would need in order to do that evaluation. Get a proposal in the person's hand so they have a feeling of what the finance structure looks like. And at that point, if we're all on the same page and want to move forward, we're typically funding loans within 45 to 60 days, the date we receive that proposal letter back.
Great. Last question here. What is the easiest way to identify sellers? And I'll kind of jump in here quickly. As I mentioned, we pulled in the insurance segment into Succession Link just about 2 months ago. I think we have about 1,000 registered users, and of that, I think we have about 40 or 45 sellers that are on our platform. So that's certainly a place that you can go on. You can register for the free account, have the ability to find if there's users looking to sell their practices in your area. And then, Mike, does Live Oak have any resources for identifying sellers?
We do on occasion. We'll have sellers come to us, but for the most part, it's buyers because they're looking for financing. So the vast majority of our contacts and who we work with are obviously buyers that are looking for, a loan. By way of where we see some of our customers finding deals, a lot of it is through, networking through associations. An outfit like Succession Link is a great resource. Kind of one location where you can go through and kind of look at the opportunities as they appear. But I would say it is a challenge in finding deals, and some of the better deals, or a lot of what we see, the more successful borrowers have networked through either agencies or have discovered opportunities just through relationships. So that would probably be the two pieces of advice there.
Great. Well, that concludes all the questions and concludes the presentation for today. I want to thank everybody that joined us. Again, we'll be redistributing the audio version and video version of this presentation, and I will be sending out my contact information as well as Mike's. And if anybody has any additional questions, feel free to reach out. Mike, anything else on your end?
No, that'll do it. Nick, thanks for the opportunity. Really appreciate the opportunity to address everyone today. And thanks again.
Thanks, everyone. Have a great day.